Look at the screen right now and focus on the numbers burning into the digital fabric of the global markets. $79.57. That was the high of the day. We closed just a fraction below it at $79.11. We are exactly 43 cents away from $80 an ounce. Now stop and think about where we were just 48 hours ago. Think back to Christmas Day. While most of the world was sitting down to dinner with their families, while the lights were twinkling on the trees and the markets were officially closed, a silent monster was waking up in the shadows of the financial system. I turned on this camera while you were celebrating because I saw something in the data that terrified me. I warned you about Ghost Week. I told you that the period of low liquidity between Christmas and New Year creates a vacuum in the heart of the global economy. In that vacuum, price discovery does not happen in cents. It happens in dollars. The volatility is violent, the moves are vertical, and the major banks are caught asleep at the wheel. That was only 2 days ago on December 25th, and here we are on December 27th. What we just witnessed was not a drift higher. It was not a nice little rally. It was a total detonation of the silver market. We ripped from the $71 level straight through 75, 76, 77, 78, and we kissed $79.57. We put in an $8 candle in a single trading session. If you are watching this and you are still skeptical, if you are still sitting on the sidelines thinking this is just another bubble, you are missing the most obvious signal in financial history. We are witnessing a market that has completely broken free from its chains. This is a blue sky breakout. When an asset breaks its all-time high, which we did yesterday at $75, all resistance vanishes. There is no overhead supply. There are no angry investors waiting to sell just to get their money back. Everyone is in profit. And when everyone is in profit and the physical supply is gone, the price does not climb stairs. It takes the elevator straight to the top floor. Silver is up nearly 6% in one day. It is up 169% year to date. It is officially the best performing asset on the planet. It is beating Bitcoin. It is beating Nvidia. It is beating the S&P 500. And yet, if you turn on the mainstream financial news right now, are they talking about it? No. They are talking about retail sales numbers and holiday shopping data that nobody cares about. This silence from the media is your biggest edge. The fact that we are flirting with $80 and the general public still has no idea what is going on means we are nowhere near the top. This is the stealth phase of a global mania. But the stealth phase is ending fast. You cannot hide an $8 daily move. You cannot hide a chart that has gone vertical. The world is waking up. And the entities that are waking up are not just retail stackers like you and me. The giants are waking up. The sovereign funds are waking up. The pension funds are waking up. Yes, the price action is exciting and making money is fun. But we need to look at why this is happening so fast. It is not just the holiday liquidity. Something pulled the trigger. Something forced the algorithms to bid silver up to $79 in a state of total panic. We have identified a specific signal that flashed on the institutional dashboards this morning. It is a signal that has not flashed since the year 2011. It is the bat signal for the largest pools of capital in the world. They are bringing a wave of capital that will redefine the meaning of wealth. While the world was watching the price flicker on their screens, the smart money was watching the ratio. Today, the most important metric in the precious metals market, the gold to silver ratio, crashed below 60. To an average person, this sounds like technical jargon or a minor statistical detail. But to an institutional fund manager, this is the bat signal. It is a mandatory call to action for the largest pools of capital on Earth. For the last several years, silver has been trading at 80 to 1 or even 90 to 1 against gold. The market was telling us that gold was the only safe haven and silver was just a forgotten industrial byproduct. But today, with gold trading at $4,532 and silver closing near $80, that ratio collapsed to 57.3. I need you to understand the magnitude of this shift for the global economy. Pension funds in Norway, sovereign wealth funds in the Middle East, and university endowments in the Ivy League manage trillions of dollars, not billions. These entities operate on strict mathematical rules and algorithmic rebalancing mandates. They do not buy based on gut feelings, social media hype, or political leanings. They buy based on historical valuation models. When the gold to silver ratio is above 80, their models often tell them to accumulate gold because it is the primary monetary metal. But when that ratio drops below 60, it triggers an automatic and mandatory rotation. It tells the investment algorithms that silver is historically and critically undervalued relative to gold. To a pension fund manager looking at a spreadsheet, this is a screaming arbitrage opportunity. It tells them that if they want exposure to hard assets to protect their clients against war risk and inflation, they get significantly more bang for their buck by buying silver than gold. Imagine a single large pension fund that manages $1 trillion. If their internal model requires a tiny shift of just 0.1% of their assets into silver to maintain their ratio exposure, that represents $1 billion of buying pressure from just one single fund. Now consider that there are hundreds of these massive funds globally. We are looking at a $50 billion wave of capital that is programmed to enter this tiny market regardless of what the price is. These institutions are what we call price inelastic. They do not wait for a dip or place limit orders. They have a mandate to fill, and they will sweep the order books to get it. This is why $79 feels like a powerful magnet. The market is pricing in this massive future demand before it even hits. The professional traders who are awake during this ghost week are scrambling to accumulate inventory right now because they know they can sell it next week to the pension funds at $85 or $90. They are front-running the inevitable. When $50 billion tries to enter the silver market in a single week, it is like trying to fit an entire elephant into a tiny car. It physically cannot fit without destroying the existing price structure. The price must go vertical to accommodate that much liquidity. This is not retail fear of missing out. This is not a small group of investors on the internet. This is the mechanical rebalancing of global wealth. On Monday morning, and especially on Thursday, January 2nd, when the full investment committees return from their holiday breaks, these asset allocation orders are going to hit the desks. They are going to see that sub-60 ratio, and they are going to rebalance their portfolios for the new year. They will hit a market that has almost no sellers and record low inventory. Once this metal goes into the pension fund vaults, it is effectively off the market. It is gone. It is locked away in the strongest hands imaginable for decades. We are at the threshold of a liquidity event that will make every previous rally in history look like a flat line. The wave is coming, and it is $50 billion deep. To understand why the price in New York is screaming higher, you must stop looking at Wall Street and start looking east. You need to look at what is happening in China right now, because the divergence between the eastern and western markets is getting wider, not smaller. I just received a snapshot of the Shanghai Futures Exchange data for their night session. This is the delayed market data that the Western public usually ignores, but right now it is the only truth that matters in the global silver trade. Look at the front month contract labeled AG2601. The last price is 19,200 yuan per kilogram. The change column shows it is up 1,177 yuan in a single session. That is a massive and violent move higher. Now let us do the math with absolute precision. Take 19,200 yuan and divide it by 7.005 to convert it into dollars per kilogram. Then divide that result by 32.15 to get the price per troy ounce. Do you know what number you get? $84.50. While New York is hyperventilating and panicking about $79, Shanghai is already trading at $84.50. That is a $5.50 premium per ounce. Just 2 days ago, the premium was $8. The United States market rallied $5 today, and yet the premium did not close. Why? Because China rallied just as hard, if not harder. New York is chasing a ghost. Every time the West steps up, China steps up higher. We are running up an escalator that is moving down. We simply cannot catch the physical price because the East is bidding it up relentlessly and without hesitation. This $84 price in Shanghai proves that the global arbitrage mechanism is completely broken. If the market were functioning correctly, bullion banks would buy silver at $79 in New York and sell it at $84 in Shanghai instantly. They would close that gap in seconds and pocket the easy profit. The fact that a $5.50 spread exists on a highly liquid asset tells you that the metal is stuck. It tells you that the Western vaults are empty, or the logistics are snarled, or the banks are simply too terrified to ship the metal because they might need it to cover their own massive short positions at home. When the pension funds turn on their computers next week and see the gold to silver ratio at 57, they will also see this Shanghai premium. Their analysts are going to see that they can buy paper contracts in New York at a massive discount compared to the real physical market in China. That makes the silver trade a total no-brainer for institutional analysts. It is like buying $100 bills for $90. It is the easiest trade on Wall Street right now. But there is a deeper reason for the Eastern panic. China is not just buying silver for investment purposes. They are buying it for industrial survival. Their solar industry, which dominates 90% of global production, is facing a silver deficit that threatens their entire national industrial output. They are stripping the global markets of physical metal to ensure their factories stay open and their green energy transition remains on track. The East is treating silver as a strategic national resource and a monetary bedrock, while the West is still treating it like a casino chip. This fundamental imbalance is the fuel for the coming explosion. The premium in Shanghai is your lighthouse in this storm. As long as New York is trading significantly below the Chinese price, you are buying at a discount. The floor of the global market is being set in the East, and that floor is rising every single hour. By the time the Western public realizes what is happening, the physical metal will already be locked away in Eastern vaults, and you will be forced to pay their price or have nothing at all. Now we must look at the hard data and the undeniable proof that the paper settlement game is ending. I have the CME Group delivery report right here in front of me. It is a digital document that would look boring to most people, but to us, it is a crime scene report. It details exactly how many contracts are standing for physical delivery in this month of December. You have to understand that December is usually a quiet transition month for the silver market. Typically, traders roll their positions forward to March or May of the next year, or they simply settle for a cash profit and go on holiday. But not this year. This year, the holders of those contracts said no to the cash and no to the paper promises. They said they want the bars put on a truck and sent to their private vaults immediately. The number of contracts standing for delivery is 12,776. Let us translate that number into the only language that matters in this market, which is physical ounces. One standard silver contract on the COMEX represents 5,000 troy ounces. When you multiply 12,776 by 5,000, you get a staggering total of 63,880,000 ounces. Nearly 64 million ounces of physical silver are being demanded for delivery in a single month from a single exchange in the middle of a holiday week. To put that in perspective, that is roughly 8% of the entire annual mining supply of the planet. All of it demanded at once. This is not normal market activity. This is a massive run on the bank. Why are these massive contract holders refusing to take cash settlement? Why are they rejecting the lucrative offers to roll their positions forward? Because they know exactly what we discussed about the Shanghai premium, and they know about the global industrial shortages. They realize that a paper contract promising you silver in the future is worthless if the metal physically does not exist in the vaults today. They are calling the bluff of the fractional reserve system that has governed this market for decades. For 40 years, the bullion banks have operated on a fictional reserve system. They sell 100 ounces of paper for every 1 ounce of physical silver they actually hold in the vault. They rely on the statistical probability that 99% of people will never ask for the actual metal. But today, the 1% has become the 10%, and the system is breaking in real time. The delivery report shows that major firms like JP Morgan and others are scrambling behind the scenes. They are having to cannibalize other stockpiles, and they are likely leasing metal from exchange-traded funds just to meet this sudden demand. If the exchange fails to deliver on even one of these 12,000 contracts, it constitutes a legal default. In the world of high finance, a default on the COMEX is the singularity event. It is the end of the current pricing mechanism for the entire world. If a holder stands for delivery, and the exchange is forced to say they do not have the metal and offers a check for the cash value instead, that is called force majeure. The moment that happens, the price of silver goes to infinity overnight. Every other contract holder on Earth will immediately realize their paper is worthless, and they will rush to buy physical metal in the spot market at any price. You will see paper silver trading at $80, while physical silver trades at $150. The market will bifurcate and the paper market will die. This record delivery volume is the countdown clock to that exact moment. It proves that the industrial panic is real and that the speculators have been replaced by strategic buyers who need the metal to survive. These entities are draining the swamp, and as the vaults empty, the price of silver is no longer a matter of opinion or technical analysis. It is a matter of physical reality, and that reality says the price must rise high enough to stop the bleeding. The physical stress we see in the silver vaults is bleeding directly into the heart of the global financial system. You cannot separate the metal from the money because in the world of high finance, they are one and the same. When the major bullion banks are forced to source 64 million ounces of silver in a market that is going vertical, they hemorrhage cash at an unsustainable rate. They have to pay massive premiums to find any available metal, and they have to pay for expeditious shipping and high lease rates just to stay solvent. Their liquidity dries up instantly. This is why we saw a smoking gun in the financial data this morning. The Federal Reserve was forced to inject $17 billion into the repo market facility. This $17 billion move was not a coincidence, and it was not a routine year-end adjustment. It was a direct consequence of the delivery crisis and the short squeeze we just discussed. The silver market has become a black hole for capital. It is sucking liquidity out of the banking system at a rate of billions of dollars per day. The Federal Reserve noticed the red flags on their internal risk monitors, and they stepped in to refill the pool. They are trying to keep the banks liquid while those same banks scramble to find physical silver to cover their failing short positions. But here is the critical problem that the mainstream media is ignoring. This is a classic trap. By printing money to help the banks buy silver, the Fed is devaluing the dollar. When the dollar devalues, every hard asset, including silver, becomes even more expensive. This forces the banks to need even more money to buy the same amount of silver next week. It is a self-defeating feedback loop. It is a doom loop of the highest order. Think about the signal this sends to the global macro investors and the sovereign wealth funds. The United States dollar is supposed to be the risk-free asset of the world. But today, the Fed effectively admitted that the banking system backing that dollar is so fragile that a $5 move in the price of silver threatens its systemic solvency. They admitted they have to print money to prevent a total bust in the commodities sector. This is the ultimate pivot point. The Fed cannot fight inflation and bail out the silver shorts at the same time. Those are two opposing goals. They have chosen to save the banks, and in doing so, they have officially surrendered to inflation. Every single dollar they print to suppress this crisis acts as jet fuel for the next leg of the silver rally. We are watching the restart of quantitative easing in everything but name only. The Fed has now become the buyer of last resort for the bad silver bets made by the big banks. Because the Federal Reserve has infinite digital dollars but zero physical silver, the price of the metal has to rise to reflect the massive new supply of currency. For 20 years, the Fed put was under the stock market. Today, the Fed effectively placed a safety net under the price of silver. By bailing out the short sellers, they have capped the downside risk for every holder of real assets. If the price of silver drops, the physical shortage accelerates because it becomes cheaper to buy. If the price rips higher, the Fed is forced to print more money to save the banks, which causes more inflation and drives the price even higher. It is a win-win scenario for the silver holder and a nightmare for the central bank. The $17 billion injection was the flare gun in the dark. It revealed that the fortress of the dollar is cracking from the inside. The only way the Fed can keep the walls standing is to burn the currency itself as fuel. They are caught in a liquidity trap of their own making, and the only exit is through much higher prices for everything that cannot be printed. I titled this update Danger Next Week for a very specific reason. While the fundamentals have never been more bullish, and the 64 million ounce delivery demand is historic, we are walking into a tactical minefield. When you have a market that has moved this far and this fast, and you introduce a massive new class of institutional buyers clashing with a class of desperate and cornered shorts, you get volatility that breaks things. Next week, the holiday volume returns. The senior traders are coming back to their desks in London and New York, and they are going to look at this $79 price with a mixture of shock and aggression. They are the adults in the room, and they have to make a decision. Do they chase the price, or do they try to smash it? If they chase it, we go to $100 in the month of January. But if they try to smash it, they will use their remaining paper leverage to force the gold to silver ratio back above 60 just to break the bullish psychology. We could see a flash crash next week that would make your head spin. We could see silver drop $10 in 10 minutes only to recover the entire move an hour later. This is what we call the widowmaker zone. It is the place where over-leveraged retail traders get wiped out right before the real move happens. The banks know that retail investors are chasing the trend right now. They know many of you are using 10 times leverage and feeling invincible. They want to paint a massive red candle on the chart to trigger your stop-loss orders. They want to make it look like the top is in so they can scare the pension funds away and buy back their own shorts at a lower price. If you are sitting there with heavy leverage or trading short-term options with money you cannot afford to lose, that wick will kill your account. You can be right on the fundamental thesis and right on the direction, but still go bankrupt because you could not survive the volatility of the breakout. This is why I am telling you to be incredibly careful next week. Do not get greedy with leverage here. The move is already vertical enough, and you do not need to amplify it to make life-changing gains. Holding the physical metal or holding unleveraged positions is the winning strategy in this environment. If the price flash crashes $10, the physical holder just shrugs and waits because they know the vaults are empty. But the leverage trader jumps out of a window. You must choose to be the physical holder. But there is another side to this danger, and it is the danger for the banks themselves. While they might try to smash the price, they are running a massive risk of losing total control. Because of the $50 billion pension fund wave waiting to allocate any dip the banks create will likely be bought instantly by institutional algorithms. If they smash the price to $72, the pension fund models will see an even more attractive ratio, and they will step in with massive buy orders. The banks are trapped in a checkmate scenario. If they do not smash the price, it goes to triple digits immediately. If they do smash the price, they provide the liquidity for the whales to enter, who will then drive it to $100 anyway. The volatility we expect next week is just the sound of the pieces moving around the board before the king tips over. You need to have a stomach of steel, and you need to turn off the minute-by-minute charts. Look at the daily candle and look at the weekly trend. As long as the gold-to-silver ratio is diving, the trend is your friend. The banks are running out of physical ammunition, and paper games only work until someone demands the metal. Next week is the battle for the $80 level, and it will be the most violent week in the history of the silver market. To understand the full magnitude of this silver explosion, you must look beyond the trading floors and toward the global map of geopolitical conflict. We are no longer living in a world of peaceful trade and predictable diplomacy. We have entered the era of the war economy where commodities are used as weapons and financial systems are the primary battlefields. The headlines you see today about the United States blockade on Venezuela are not just a footnote in the news cycle. They are a direct catalyst for the panic buying we are witnessing in the precious metals market. When the United States Coast Guard seizes oil tankers and President Trump announces the retention of seized assets, it sends a clear and terrifying message to every nation on earth. The message is simple. If you do not follow the mandates of the Western financial order, your assets can and will be frozen or confiscated. This realization is driving a massive flight to safety that the world has not seen since the 1970s. Nations like China and India, along with sovereign wealth funds in the Middle East, are watching these events and reaching the same conclusion. They cannot trust a digital dollar that can be turned off with a single keystroke. They need a strategic reserve that is physical and beyond the reach of any single government. Silver has recently been added to the critical minerals list by the United States Geological Survey, and this confirms its status as a strategic asset of national security. This is why the dollar index, known as the DXY, has been tanking even as geopolitical tensions rise. Historically, the dollar rises during times of war as a safe haven. But today, the dollar is down nearly 10% for the year, trading at its weakest level since the year 2022. The market is realizing that the crisis is the dollar itself. The crisis is the solvency of the government that issues the dollar, which is currently carrying $38 trillion in national debt and paying $2 trillion a year just in interest. When the Federal Reserve prints $17 billion to bail out silver shorts, they are effectively admitting that the dollar is being sacrificed to save the banks. Investors are connecting the dots. They see that the only way for the United States to manage its massive debt is to inflate it away by devaluing the currency. Silver is the only lifeboat that cannot be diluted by a central bank printer. You can dilute a currency, and you can even dilute digital assets with new protocols, but you cannot dilute element number 47. It is forged in the heart of supernovas, and there is a fixed amount in the crust of the Earth. The geopolitical contagion is spreading because trust is the only thing that gives fiat currency value, and that trust is evaporating in real time. Beijing and Moscow are not just watching the United States banking system bleed, they are actively pressing the advantage. They know that by keeping the physical silver market tight, they can force the Fed into a corner where it must choose between a banking collapse or hyperinflation. This is financial warfare at its most professional level. The $80 price of silver is not just a market quote, it is a score on a global battlefield. It is a reflection of the fading dominance of the dollar and the return of real tangible value. As the blockade on shipping continues and war risks escalate, the demand for silver will only move in one direction. We have crossed the Rubicon, and the era of paper promises is giving way to the era of physical reality. We have arrived at the conclusion of this report, but in reality, we have arrived at the beginning of a new monetary epoch. The events we have witnessed this week, from the panic in the repo market to the 64 million ounce delivery demand, have confirmed the one thing that every gold and silver investor has been waiting for: the pivot. For 2 years, the mainstream media has obsessed over when Jerome Powell would cut interest rates or when the tightening cycle would end. They were looking for a polite announcement or a ceremony. Instead, the pivot arrived in the dark of night. It arrived as a desperate $17 billion injection to save a banking system that is choking on its own leverage and its own failed silver shorts. This changes the calculus for silver entirely. We are no longer just looking at a supply and demand deficit or a technical breakout. We are looking at a fundamental currency devaluation event. My price target of $100 is no longer a speculation based on industrial usage or solar panel demand. It is now a policy certainty. It is the mathematical output of the equation the Fed just wrote. If they have to print hundreds of billions and eventually trillions of dollars to keep the repo market liquid and the derivatives complex from detonating, then silver at $100 is actually cheap. In a hyperinflationary liquidity cycle, $100 is simply the new 20. So what is the roadmap for the coming weeks and months of 2026? First, you must understand that the volatility will be extreme. The beast is wounded, but it is not dead. The banks, armed with their fresh $17 billion of Fed liquidity, might try one last desperate smash to break your resolve on Monday morning. Do not let them. If you see the paper price drop $10 in a flash crash, you should not panic. You should smile. Realize that every time they smash the paper price, they are just making the physical metal cheaper for the savvy investors and the sovereign nations who are draining the vaults. A paper smash in a physical shortage is like putting a sale sign on an empty shelf. It does not create new inventory, and it only accelerates the final panic. Second, you must prepare for the unobtainium phase. We are very close to the moment where the major dealers simply run out of stock and the buy button disappears from your screen. Once the wholesalers are empty, the retail shelves go bare. If you are sitting on cash waiting for a perfect dip, you are playing Russian roulette with a fully loaded gun. The risk in this market is not that you buy too high. The risk is that you cannot buy at all and the doors close behind you. Finally, remember that wealth is never truly destroyed, it is merely transferred. It is currently transferring from those who hold paper promises and currencies to those who hold real tangible things. For 40 years, the wealth flowed from the real economy into the financial economy. Now the tide has turned. The real economy is devouring the financial economy. You, the stackers and the holders of physical assets, are the new captains of capital. The banks are insolvent and the Fed is trapped. The vaults are empty and the war is escalating. Do not sell your position for a fiat currency that is being printed to bail out your enemies. Hold the line. When silver hits $100, do not trade it back into the burning building of the paper system. Use it as collateral or trade it for land and businesses. The $17 billion signal was the flare gun that lit up the battlefield. The game is rigged, yes, but for the first time in history it is rigged in your favor. The ghost week is ending and the reality is beginning. The $100 wave is unstoppable and you are the ones riding it to the shore.